pleasure host you here, and I'm happy that we can kind of finalize that journey with the U.S. tax system and tax, let's say, uh, risks, specific opportunities, etc. So it's been a while, and we haven't seen each other for about 1 month yet. So
Yeah.
those who's watching us for the first time, please check up our first two webinars. There we started to uh, basically to our journey in this U.S. taxation, and there are a lot of interesting, let's say, aspects, advices, and blind spots that me in particular haven't seen and didn't know about it, even despite that I deal with U.S. Corporate and tax fields for the last 13 years. So, Dima, so we have
Thank you.
we have talked about maybe 25, 24 slides, and you have 20 left, so, or even more.
Yeah. Have to
So
move
please,
move
yeah,
quickly.
re remind where have we stopped our
Yeah, yeah,
previous
that's right. Yeah,
discussion.
I will do it. Thank you so much, Zhenya, and thank you for having me here. Always pleasure to speak about all these issues since you understand it so well and you can ask all the
Cool.
interesting questions. This is amazing. Okay, all right. Just briefly, I'll tell what we covered. We covered two types of taxation, two main income tax in the United States is when the entity, like if entrepreneur starts an entity in the United States, they can start it and be taxed on a transparent basis when the entrepreneur pays tax, or on opaque basis. That's when the entity pays tax. And that same principle applies to residents or non-residents. So it doesn't matter if you come from another country, you can still utilize those two types of entities. And that creates a lot of interesting opportunities and traps. And we went through all of that for um, transparent entity. You have to watch out for effectively connected income or fixed terminal annual or periodic income, which could lead to negative tax consequences. And sometimes the entrepreneurs need to file their personal taxes in the US, so extra work. Then for opaque, what we saw that there's a double taxation. So you pay tax. Then if you want to liquidate the company, there is also an exit tax for an opaque entity. Sometimes, if value is not high, it's okay. But if you accumulated a pretty good value inside of your US corporation, so you don't want to pay that exit tax. So, and then we looked at the recent regulations that literally were finalized on January 15th, 2025, that cover various types of software sales.
Right.
And I'm actually right now on the screen,
Mhm.
and we can just briefly go over it. So we talked about one type is transfer of copyright rights. Is when you sell the rights to something,
Mhm.
and then the purchaser can then exploit those rights to the fullest as they wish. Transfer of copyrighted articles is when you sell downloadable software, for example. That would be copyrighted articles, one on one, like one at a time. Okay, transfer of know-how, it's also very similar to the transfer of copyright rights, is when you just give somebody know-how and they use it as they wish. Provision of services, that's when you work on customer software, custom-made software, for example, or you have a full-time employee who lives outside the United States and you provide that service to to the recipient in the US. So that's all provision of services. And then SaaS is when you have a website and you go on the website and use services of that website to calculate something or to create pictures, you name it. And in each case, now we have clear understanding how it's taxed. It used to be for many years we didn't. Now we do. Okay, so
And
it's
Dima, just a quick question. Why was it
uh,
not so clear before? You said that it's more now, it's more transparent and let's say structured now.
yeah.
But what was the situation before?
It's,
Just few words.
yeah. Some of it was clear. Some of it was always sort of more or less clear. Situations, for example, when you sell the rights outright. Let's say you sell know-how or copyright rights, and you just receive a lump payment, and you don't want anything else, right? You just receive one big payment, and you're done with that.
Yeah, we had such
That was
deals
always clear. Yeah,
in our
that was
practice.
always clear. But for the rest of it, somehow, because it's like, for example, software as a service. There was a big, long discussion when you use somebody's website. Are you paying a rent to use that website, or you paying as a service somebody to run that website and provide all those details on it? So that was vibrant. There was a tension, constant tension about it. Yes, IRS sort of said they're going to say it's going to be service, but they never finalized the regs. So this hasn't, and now they did finalize. Or another example I want to bring is the transfer of copyrighted article. When you download the software, so the question, where do you think the sale occurs? Where you physically present at the moment? Maybe you're a foreign country, or where you usually live. Maybe you live in the United States, but you know and that was also not clear, and they
Hmm.
clarified it. So they going by your billing address. It doesn't matter
Hmm.
where you are located,
Got it.
unless there are abuses. Because they say, okay, it's going to be billing address, but you can abuse the system to create all those billing addresses within the United States, and then if we see there is abuse, we'll come and recharacterize it. So it's still in the middle, but okay, billing address under normal circumstances.
Got it.
So
Got it. Thank
that's
you.
why, yeah, so that's what the issue was. And we covered it in the past. I think previously, I think we might have covered it, or maybe
Yeah,
not.
we
But
did.
the idea here is right. As I was saying, the copyrighted articles is the billing address. Anytime when there is a royalty, when there is a license, it doesn't matter because you can transfer copyright rights on a licensing basis where you receive payments every year. While in that case is different from when you sell it outright. If you receive
Hmm.
licensing payments every year, that's sourced to the country that pays it. So if United States entity or person pays for the license of your copyrighted rights, well, in that case, you will you will have a problem. You will have a U.S. source income, and you may be taxed on gross, right? For example. So in all of it, so if it sells outright, is no U.S. source. If it's licensed and there is periodic payments, then U.S. source. And if it's SaaS, then we treat it as services. Okay, meaning that it's sourced to where services are provided. You can look at our previous video for more details.
Hmm.
Um, okay, so you know,
Wait.
one
That
thing
was interesting.
yeah,
Could you come
uh,
to the slide 26? That was interesting statement.
yeah, yeah,
Final
uh,
recommendations. So for foreign-owned LLC, best for low
uh-huh.
risk. Could you comment this, please?
Yeah. Let's look what it says. Okay, best. So foreign. If you want to go to U.S. market as a foreign, individual. Okay,
Mm-hmm.
so you'll be confronted again, as I said, opaque and transparent. LLCs usually tracked as transparent. That's why they created.
Mm-hmm.
And here we're saying that it's best for low risk, non FIDEP, and offshore oriented businesses.
Mm-hmm. Mm-hmm.
SaaS, hosted abroad, pure software downloads, know how,
Cool.
sales
Cool.
outright.
Mm-hmm.
Okay, so
Mm-hmm.
or services, right? So
Mm-hmm.
basically, you're fine if all you do is you sell one software that people pay you one time and they're done and
Mm-hmm.
they're forever theirs. You're okay if you have a software as a service and all your servers are abroad
Mm-hmm.
and all of your employees and everybody's abroad. That's
Mm-hmm.
then
So in
low
this
risk.
case, LLC is a front company, which is basically your
Yeah.
kind of
LLC, yeah,
uh,
right. In this case,
mhm,
LLC is preferred. I think it's preferred because if all of your operations are outside the US,
mhm,
why would you want to subject yourself to US tax via corporation? Maybe, and a lot of people they start with trying things out, and then if things go well, then they attract investment and so on
mhm,
and so forth. So
mhm,
you want to first try things out, then if you
mhm,
have to, you can always move from LLC to corporation.
mhm,
But
mhm,
moving back from corporation to LLC,
mhm,
it's exit tax. You have
mhm.
to pay. It's
Got it,
21%.
got it.
You know.
Mhm,
So yeah. So then for C corporations, what's best? Um, if uh, if it's SaaS, well, it's a little contradictory what I say. So if somehow for SaaS you have to use US servers, you have to use maybe some other US facilities, well, then you just make it as a C corporation if you don't want the
mhm,
complications.
mhm,
If
mhm,
it's still okay, sometimes you can do a little,
mhm,
you can figure things out where it can still work, but with no complications. Okay. Then, of course, if you're looking for VC funds, and we talked
mhm,
about it for some reason, of course,
mhm,
VC prefer it when it's not pass-through entity. And of course, if you have US office, so then you do this. And if you have license, so the main thing, so if your business is where you have a software running and then you charge license fees and then you make sales
mhm,
inside software sales, well, but mostly when it's licensing, well, then you don't want to get into the FDII and license situation unless, of course, you're from a country where there is an agreement between US and that country, and sometimes those licenses are taxed as zero. So you don't. It's a what is it? Treaty exemption. So in that case, in those types of situation, you might still be fine writing it through an LLC rather than C corporation. So those are considerations. Okay.
mhm.
Right. Okay. So let's see. LLC's got a partnership. Uh-huh. Yeah, that's doesn't add. Okay, so here, okay, here, simplicity operational control, asset protection, that's for LLC. It's kind of somehow the slide set up with a lot of re-summarizing many concepts. So, you know,
Can you please
I,
give some comments on the previous? So disregarded entity and partnership area, it means that these are the benefits that so simplicity. You just need few steps
yeah,
to run this LLC. And you just need
yeah,
its owner
yeah,
owner managed structure. So it means basically it's one owner company. Asset protection, that makes sense. So liability is limited by the capital of this LLC, and flexibility, easy to structure joint venture and profit sharing agreements. Indeed, actually, for the startup, which do not uh, which doesn't want to raise funds, VC funds, or you just want to start working on the US market or on the global market with a good jurisdictional brand. I mean, as a US company, this is pretty good option, right?
Think so. I think so. Again,
Hmm.
we would have many clients who choose that when the in fact, as I described before, the facts are right, and it works very well. It works
Hmm.
extremely well, especially when it's simplest annual service
Got it,
business.
got it.
There's like
Hmm.
no problem. And then that is, yeah, I don't know why there are two slides about the same. I don't know if it's
It
exactly the
seems
same.
it seems like it's a conversion option. So actually, it's pretty interesting that US gives this opportunity when you can transform your legal entity from one type to another. For instance, there is
Yeah.
no such
Yeah, yeah,
option
yeah,
in,
yeah, yeah.
Ukraine or in
Right.
other jurisdictions
Right.
as well, especially with continental law. So yeah, it's cool one. And
Yeah.
privacy often more discreet owners may not be public listed. That's
Yeah.
cool.
Yeah, 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 yeah. So, conversion option. Oh, yeah, conversion options. Can let it convert C corporation. Yeah, yeah, and then other more to describe privacy, of course. Yeah, okay. So now C corporation, of course, typical Delaware.
Hmm.
All this credibility, yes, credibility. Equity compensation. Yeah, and another thing you have to also remember that with LLCs is a little more difficult to do equity compensation because
Indeed.
you don't want
Indeed.
to have like a 100 partners, and that's
Hmm.
going to be very complicated. So here, of course, when you have a corporation, then you can just take your equity and distribute among your workers or interested parties, stakeholders.
Hmm. Hmm.
Um, there is something about this clear IP ownership. I guess it's something legal, perhaps it's not scalability. Sure, but all it is just corporations are designed for big
Raising
businesses,
funds
so
and big
rising
businesses, right?
funds. That's right. That's right. That's what it is. Yeah. So once you try things out, most likely you will end up going to C corporation. But here's another thing. Here's, of course, there could be an in-between solution where you could open US corporation, C corporation, and you can license IP from yourself to that C corporation. And for
Oh,
the time
good.
being, what can happen, right? What can happen is that C corporation pays your license fees, and they may or may not be taxed. They may be taxed in very limited fashion. So you could look how it works. Um, but then what happens is that so it yeah so right then what happens is that you you can avoid all these potential problems like effectively connected income, uh, tax on gross. Okay, you can avoid all these problems. You could take deductions inside of that C corporation and pay yourself royalty or license
Wow.
fees for whatever income
Wow.
you want to
So
take.
so it's legit, right? So you can do that.
Yeah, yeah, yeah,
Cool.
yeah. It's totally legit. It also it basically shields this sort of structure shields a person from a risk of being personally responsible for tax in the US. Like, for example, if you do SaaS, software as a service, and you absolutely have to keep service in the United States, then there's so many uncertainties. It can be taxed in the US, personal taxation. So you can just say, all right, so I create a C corporation. I do not put a P into this corporation, but I license my software to it and it continues operating.
I see.
So that
I see.
definitely a beautiful, variant.
Hmm.
Okay, so it's kind of in between.
Oh,
So here's
this
again
is
summary chart.
I love it. I love it, guys. Who is watching us? just take a detailed view on this, and I like this chart. Basically, if you run a startup, or
Yeah,
if you want to set up a company in the US, take this chart and see how what is the best option for you, right?
right. That's
Yeah.
probably would be good, right? Exactly. Uh, and again, so as I always want to say, all this knowledge, if you're a person who is starting a business, entrepreneur, all this knowledge allows you to discuss those issues with your tax advisor
Yeah.
on a
Ask
pretty
right
intelligent
questions.
basis, and that's what it's
Ask
for.
right
Because
questions. Yes.
yeah, ask that questions. Yeah. It's very important. It's super, super important because every situation is very different, and
True.
usual advice is very tailored to needs, but at least you know the
Indeed.
issues.
Indeed. Indeed.
Okay. State. Okay. Now we're back to our beautiful state tax. So this is federal part, right? So this is
Mm-hmm.
federal part, but federal is just one ju- jurisdiction. In the US, we have 52 ju-
Mm-hmm.
jurisdictions, right? So let's count. 50 states, one the District of Columbia, and the federal. So we covered one. Now we have to cover the other 51.
Mm-hmm.
So that, of course, since not everybody, does business in all the states, and there are some nexus rules. So we're not going to dive as detailed into the state, but I have to tell you guys, it's very different. So it's different, and it may be you're not subject to tax on the federal level, and states still make you pay tax on the state level. So so that would have to be separate to do all the 51. But okay, for like in general, in order for a state tax apply, you would have to have what we call nexus in the state, right? And for income tax purposes, then it's established when a business has a sufficient connection. So nexus connection or presence in the state, allowing that state to impose income tax. And so here's like summary of most popular key rules. So it's physical presence. So if you have an office or employee, you have an agent of the state to whom
Mm-hmm.
you direct what to do. So then they will consider you having nexus there, enough connection, to pay tax. An economic nexus, if you make enough sales into the state. So here it says, for example, 500,000, but for some smaller states like North Dakota, tiny, even Washington State, they consider themselves small. So they're looking at, well, Washington State doesn't have income tax, but any other small state, they can have as low as $100,000
Mm-hmm.
sale nexus.
Mm-hmm.
So then you have factor presence nexus. So they have formula base. Like for example, California, they just say if 25% of your payroll sales or rent is in the state, then you already have state nexus. It's very low, pretty
Sweet.
low.
Very sweet. Very
Um,
sweet.
uh, Yeah, right. Yeah, crazy, crazy. And then factors, yes, and then public law limitation. So the business selling only tangible. So if you engage in sell tangible personal tangible property, and all you do in state is you solicit activities, so you engage in soliciting activities. So you could be exempt under the special law, but it only applies to tangible personal property. So
Got it. Mm-hmm.
now what before I move forward, so we're going to cover all those beautiful laws right now, but I don't know if you guys are aware, we're making this recording, and what is it today, June 21st or something like that, so of 2025. So there is a bill they call one big beautiful bill in the US
Wow.
right now, US Congress. Trump, yes, one Trump insisted on the name, one big beautiful bill, and inside of it, we like as practitioners and as maybe taxpayers, we're cautiously optimistic. I think what they're trying to do there, they're trying to um, extend this public law protection to software. I think that's what they're doing. Um, I'll have to double check, but there are some changes that might be happening. But of course, can you imagine 51 jurisdictions are probably not going to be happy with that? And I don't know if it's going to pass. Not we have different laws right now, but it might be that federal will limit the way that they can tax everybody.
Oh, wow.
So it won't be easier.
Wow.
Yeah. So that yeah, they might require actual physical presence, not just sales. So they
Hmm.
on the federal level, but I don't know because usually if federal says that, then state will come in and they say it's unconstitutional. You don't have right to
Hmm.
do it, and the whole battle will continue again
Hmm.
and again. So there's actually no perfect. Yeah. Okay, now the law stands right now. So basically, for corporate income tax, when we have what we call apportionment schemes, and that means, for example, if you have sales, you have rent, and you have employees in the state, some states say, okay, we're going to take all of these three factors in consideration. But some states simply say, we don't care about any other factor but the sales. We're just going to take sales into account. And it used to be that most states had three-factor apportionment when they take all the factors, but now more and more states just move to single factor.
Oh,
So we're just going to take
wonderful.
your sales and we're going to measure where you sell things. So
I see.
again,
Hmm.
that creates a lot of problems because if some states have three factors, some states have only sales. Can you imagine that it could be that you pay the state tax on the same income twice? Because one state tells you, okay, you mostly do business here, therefore we're going to tax you. Some other state, oh, you have a lot of sales in our state, we're going to tax you that as well. So it can create some problems. Um, so then law rights. Okay, so there's just examples. For example, what we're looking at if you get into this income state taxation. Right, North Carolina to 2.5%, Missouri 4%, medium to high, New York 6.5, California, and New Jersey. New Jersey is very expensive, basically, because next to New York, I think they say, okay, well, we can afford it. Individual income tax rates, again, sometimes, as I was telling you, you have to file taxes on personally if you get into the situation with effectively connected income. And here we have Arizona, right here, Colorado, smaller ones, and of course California is 13.3%, pretty high. New
Amazing.
York and New
Amazing.
Jersey there too.
Wow.
So New York, New Jersey too high. Yeah, so you could get into those issues. Okay, now we again revisiting for some reason Nexus, economic Nexus, but I think we covered all this. But just to say, current threshold is 100,000 in annual
That's that's kind of
sales or
low.
200
So
transactions.
so even if you have
But in some
if you,
states, like yeah. But let's say in California it's 800,000, unless it's 25% of your sales
I
is
see. Yeah,
800,000. It's for smaller states because they
I see.
consider if it's a smaller state, maybe
Uh-huh.
it's not going to. It's unfair to expect that so much sales will be done there.
Got it. But
Uh, that yeah. So
Dima, just double checking. You pay
uh,
only for that piece of revenue that you collect from this specific state, or you pay this state tax
no,
from the gross? Um,
yeah, that's a good question. Yeah. So you pay tax based on net. You never
mhm.
pay on gross. You pay on net.
Yeah, yeah,
But
of course.
then this is what apportion. And then we say, like for example, maybe I should have explained. My apologies. So, for example, you make 100,000 in net income, right?
Hmm.
You make 100,000 net income,
Hmm.
and then you have various states. You sold a lot, like more than 25% of your sales were into California, but let's say you operate in some other state. Um, you operate in some other state. So we say, okay, in California, let's say had 40% sales, then $40,000 of net income, 40% of 100 will be subject to state to tax in California. Okay. Well, let's say you operate in some other state X, let's say Florida, where you have multi-factor apportionment. You then and you have, and let's, I don't know, 10% sales to Florida, and all of your employees and all of your, let's say, rent is in Florida, then you'll pay, I don't know what that would be, close to, 80,000 tax, close to tax on $80,000 to California. I mean, to Florida. You know, that's where you can get in trouble because when you live in Florida, and let's say you pay tax in California, New York, and other states, where that's where you can easily get into double taxation because Florida uses three-factor apportionment as an
Hmm.
example, right?
Hmm.
So that's how it works. That's how we calculate.
Got it. Got it.
So it's net, but apportionment can float pretty much. Um, uh, Types of nexus. So I'm not exactly sure, but okay. So what's interesting is that we have this clicks through nexus again. So if you have affiliates in the state and people go to those affiliates in those states and they click on your product and service and buy there, that creates
Dima,
those things.
just a brief,
Marketplace. Yeah,
sorry, just a technical question. So, as we had some changes in our schedule, we started a bit later. I need
yeah,
to finalize our webinar in 5 minutes. How do you think?
yeah.
Is
Okay.
better to make it another webinar and to go deeper into tax state matters on the state level? Uh, shall we do that and then move to other parts? How do you think about that?
Yeah, there is one more. We could do that. Yeah, it would be fine. But there is one more. We have this, inheritance tax. Yeah. So what's left?
I
The
think
question.
we need
There is
to.
not much left, actually. Much left. Huh?
Uh-huh. You know that.
Yeah.
So you think it's better to cover it now or with this with a separate webinar? What
Yeah,
do you
I
think about that?
think we can quickly cover it real quick. I think if
Okay.
I can fit in 5 minutes, and then if people have
Yeah.
questions, they can email. So one thing I just want to say, and I think some of the slides actually covered sales tax as well. So many states have sales tax, and
Mm-hmm.
it's very similar idea. Economic nexus, you make sales in the state, the same thing, then and the rates vary. But in addition to sales tax, also very important to remember that some states have gross receipts tax, and
Oh.
they can
Oh.
be, so the sales tax rates again from 0 to 7.25 in California as a state, but frankly, for localities it can reach 9.75 in California if our tax is applicable. But some states, let's see which ones, gross receipts, like be very careful. Washington. So as soon as you reach nexus there, service or anything is subject to this very little tax, but subject to tax. Hawaii, New Mexico, Ohio, Texas. If
Wow.
you sell into the
Wow.
states, watch out. So they have low thresholds and taxes on gross sales, not on sales tax. In addition to sales tax, they have this gross sales tax.
Wow.
Now, yeah, right. Now, let me go and that's it. And states, and as I said, the main thing for you to remember, even if your business is not subject to U.S. federal level tax, it can be subject to states' income tax, and it can be subject to state sales tax. So it's as crazy as
Can you
that. It's as
can
crazy
you
as that.
can you please
Uh,
can you please give us an example for the sales tax? So if you sell in California and you consider it as the you need to pay this local state tax, then in addition
I'll give you
you
an example. Yeah. Sales tax. Yeah. All right. Let's just say you're out of country, out of state,
hmm
and you sell some services, certain type of services to Texas, for example,
hmm
and you focus on Texas market, they pay. So you'll be subject to there's a franchise tax in Texas, number one. And number, well, it's not that high. But number two, there are some sales tax in Texas. And I think, if I'm not mistaken, you will owe to the state of Texas withhold tax. And by the way, all this idea of sales tax in US, it's sort of two-sided. There is a sales and there is a use tax. And those are two sides of the same coin. So if you sell to somebody, like say you have sell some services in Texas, and you don't withhold tax, the person who pays, they have to pay use tax because they use the services, they have to pay use tax. But all the withholding sometimes and very often put on the people who sell the services because they somehow, their businesses, they're better organized to collect sales tax, and they insist on that. So just as a caution. So you have to, and we do those studies all the time. We'll do the studies right now. We did the study of 50 states for some SaaS business. We concluded that in
I got it.
25, I think, states that particular SaaS business will be subject to tax. So it's actually very, very common to go through those studies for larger operations. Okay, and the final note about estate
hmm
tax, inheritance. So if you have a C corporation in the United States, and in
hmm
some cases LLC, but it's mostly applied to C corporations, and you own it personally, either as an investor or as a founder. And unfortunately, let's say not you, maybe like someone, person X, and that person X dies all of a sudden. US will charge you estate tax or inheritance tax. So you have to remember that. So when you start US corporations and you start C corporation, you automatically will be subject. And the taxes are pretty high. It's 40%. It quickly gets to
Wow.
40%, the rate is.
Wow.
And basically, yeah, it's crazy. And those are states. I'm giving here the states. In addition to federal, you have to pay the state over here.
Wow.
So the way to avoid it is to own U.S. company, U.S. corporation through a foreign corporation. And if you own U.S. corporations through a foreign corporation, then you don't pay tax. So that's
Got it. Got
that's
it.
basically
That's a
it.
cool
Yeah,
one. That's a cool one.
that's basically it.
Cool.
Yeah,
Dima, we
yeah,
can you imagine
so
it took us three webinars, and even
yeah,
with three webinars, it's not
yeah,
enough time to get into these
yeah,
details because there's so many things to discuss. I'm very happy that we had this opportunity to run this show, to make these three webinars. Guys, I'm very appreciated for all who watched this till the end. I'm really much appreciated, Dima, for your time, for your efforts, and I definitely can recommend you as a top-notch professional. So everybody who needs support with accounting and tax in
thank
the
you.
US, please reach Dima. And I
Appreciate
hope
it.
I hope we'll come with some other interesting topics to discuss. Maybe go deep into some specific things like sales tax, which is very interesting for me. I have a lot of a lot of questions from my clients regarding sales tax. So I think we'll go deeper with short webinars
Okay.
specifically on this sales or some other things that people might be interested in.
Yeah.
Okay,
Sounds good. Yeah. Okay. Okay.
wonderful.
Let's deep dive. Okay. Awesome. Thank you, Jenny.
Thank
All
you,
right.
everyone.
Thanks
Thank you,
having me
Dima.
here.
Talk
Bye.
to you. See you soon.
Have a
Good
good
luck, guys. Bye bye.